Ignite your engines, you're on the grid with Motor Maven. Today we're diving into the electrifying world of EVs. China, once a frontrunner in this race, seems to be losing pace. The sales of EVs are decelerating, mirroring a global trend. Automakers worldwide are grappling not just with boosting sales, but also with making EVs profitable. The reasons are manifold. So buckle up and stay with us as we delve into why we believe a major crash is looming in the Chinese EV market. Reason number 5, the deceleration of the EV market. In recent years, China's EV market has been in the fast lane, with the count of plug-in electric vehicles, including both battery electric and plug-in hybrids, accelerating to a staggering 8 million units by 2023 alone. Currently, plug-in electric cars hold a market share of around 37%, a figure that seems impressive until you delve deeper. The growth rate has notably decelerated. In 2020, plug-in electric vehicles had a 6.3% share. This revved up to 15% in 2021, and then to 30% in 2022. However, the growth rate has since hit the brakes, dropping to 46% last year, signaling a clear loss of momentum. This percentage encompasses both EVs and plug-in hybrids. Focusing solely on EVs, they made up about 25% of the market in 2023, with a year-over-year growth of just 31%. Interestingly, the past year has seen a surge in the popularity of plug-in hybrids, which have seen an 80% increase and now account for 12% of the market. In essence, Chinese consumers, much like their American counterparts, are increasingly gravitating towards plug-in hybrids. These vehicles, offering a balance between electric and conventional power, are typically more affordable and eliminate the range and charging concerns associated with fully electric models. Moreover, the average financial power of Chinese citizens is notably lower than that of North America and Europe. As the Chinese economy decelerates, citizens are more likely to invest in real estate than in high-priced electric cars. Furthermore, it appears that the wave of early adopters has receded, and the middle class is not yet ready to fully embrace this new mode of transportation. Reason number 4, the dealership dilemma. In the previous year, China outstripped Japan to become the world's largest car exporter, a significant milestone after decades of Japanese dominance. Chinese automakers, with their competitively priced vehicles, have been making waves in global markets. However, the domestic scene presents a contrasting picture. The era of exponential growth, encompassing not just electric vehicles, seems to be receding into the past. The high point was in 2017, with a staggering 24 million cars sold. However, recent years have witnessed a decline, with the previous year concluding with a total of 21.7 million sales. The downturn has hit dealerships the hardest. The glut of EVs has made it exceedingly difficult to sell these vehicles. This has led to a wave of bankruptcies among dealerships, including some of the largest players in the market. A prime example is the Guangdong Yonggao Investment Group, a major dealership with 80 outlets across Guangdong Province. This network dealt in various brands, including global heavyweights like Honda and Volvo, as well as Chinese brand GAC Aion. However, the company recently declared bankruptcy, suspending all orders. This has left thousands of customers in a state of uncertainty, unsure about receiving their ordered vehicles or even a refund. Insiders report that this decline has been ongoing, with complaints about unpaid wages circulating since last April. Today, it's reported that the company's employees have been owed wages for months, with little hope of payment. This situation highlights the challenges in the Chinese automotive industry, particularly in the EV sector. Before we venture further, we'd appreciate it if you could hit that like and subscribe button. This supports us in connecting with more auto aficionados just like you. Now let's change lanes and navigate towards our next point. Reason number 3, China's EV graveyards. EV graveyards, currently a phenomenon unique to China, could become a global issue if the aggressive push for EVs continues. These graveyards, found in many large Chinese cities, are filled with hundreds, even thousands of abandoned EVs. This serves as a stark reminder of the importance of balancing demand and supply. Years ago, China went full throttle with electric cars to gain a foothold in the global market, as catching up with Western legacy car makers in terms of internal combustion engines seemed unlikely. This led to a boom in Chinese EV startups, with over 500 EV makers emerging by 2017. However, this growth was unsustainable. The condition for receiving government support was to sell a certain number of vehicles. Many startups sold their EVs to car-sharing companies, even though they had no intention of using them. These rarely used EVs, often lacking in range and performance, ended up in EV graveyards. This allowed small EV companies to secure financial support, but most ended up bankrupt due to their inability to sell their EVs in the regular market. From over 500 EV startups in 2017, the number dwindled to 91 in 2023, and it's expected to continue falling. Reason number 2, the bankruptcy wave approaching EV makers. As we've previously noted, Chinese EV startups are facing significant challenges for a variety of reasons. Despite managing to sell a respectable number of vehicles, they're still struggling to turn a profit. Accustomed to substantial government support, these affluent startups have yet to decipher the EV economy. Consequently, only a handful of companies are actually profitable, while the majority are hemorrhaging money. In the past few months alone, we've witnessed several EV startups filing for bankruptcy. This includes some big players that seemed incredibly promising just a few years ago. A prime example is Evergrande New Energy Auto, part of a larger conglomerate with seemingly limitless resources. Despite its resources, it failed to turn a profit or sell its models in significant numbers. The latest figures suggest that this company lost a staggering $17 million on each vehicle it sold. This isn't an isolated incident. Numerous other companies, including Letton and Neutron, have gone out of business. Even NIO, a Shanghai-based company, recorded a massive $2.9 billion loss in 2023, despite impressive sales figures in the fourth quarter. However, projections suggest a slowdown in the first quarter of this year, with expected sales figures of around 30,000. Reason number 1, the inevitable fate of most EV makers. With the EV market decelerating, it's clear that the majority of EV companies are headed for bankruptcy. As we've mentioned, the number of companies has plummeted from 500 a few years ago to around 90 today. If our insiders are to be believed, at least a third of these companies don't produce more than 500 vehicles quarterly. Their days are numbered, but they're not alone. Looking at the current market share, it's evident that the top 10 brands account for more than 80% of the plug-in market. Moreover, BYD holds a commanding 33.8% of the market. Tesla accounts for 7.5% of the plug-in segment, while other significant players like GAC Aeon, SAIC GM Wuling, Li Auto, Changan, and Geely each hold 6% or less. Considering that BYD is likely the only Chinese EV maker that has made EVs profitable, and the ongoing price war it has initiated, it's clear that the majority of the remaining companies will soon disappear. Eventually, the number of Chinese EV companies will dwindle to just a few, including Chinese legacy car makers like Geely and MG, which can survive this price war due to their strong positions in foreign markets. Thanks for tuning in with Motor Maven. Don't forget to hit that subscribe button to stay in the loop with the latest vehicle updates and upcoming videos. See you on the next ride.